stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm joined by Zach's very own Kevin Cook, who is the editor of the Taser service and a senior stock strategist here at Zach's, but he's also our resident expert on all things about behavior in investing and psychology of investing. And we need him right now because there's a lot going on with the psychology on the stock market. Either it's with companies that, are about to file bankruptcy and some people still staying invested in there, or it's about buying or trading these regional bank stocks that are very volatile and have been so the last couple of months, or maybe it's even about the small cap techie type name that people have been trading over the last year or 2 or 3 years. And are they still in it? Some of those have fallen to oblivion and are, on the verge of maybe even being delisted. These are a lot of things that are going out there, Kevin. So I'm glad to have you on this week.
Yeah, this is, such a great topic right now with this banking crisis that we're having. On Monday morning, we come in, we know that that First Republic Bank is going to get bailed out, or actually their assets were going to get bailed out, not the bank itself, certainly not the shareholders. And I was just asking, is this the final event? I don't think so, because and then we're seeing it today. So I'll let you lead it off, but there's so much good stuff to talk about here in terms of what people see, what they understand, and then where they put their money in this banking crisis.
Right. I own a couple banks in the value investor portfolio, and we've decided to stay in them because they did appear to stabilize in the last, month or so after the initial downdraft on Silicon Valley Bank and the shock of that. Then they did kind of stabilize. We've got all their earnings in, and there was no earnings blowups among the banks I own in there. And so I felt it was pretty okay to be in them. But now, as you just mentioned, they're taking another leg down because I guess First Republic being bought out by JP Morgan is not enough to soothe everyone. It feels like the masses of the short sellers and whoever else, just the crazy traders, have moved on. Now, First Republic is off the table to trade that. That's gone away. So they've gone on to the next banks on the list. And there are those lists going around of, the supposed ones that have, quote unquote issues, but do they? Nobody seems to really know. And we have some, high up people like Jamie Dimon of JP Morgan saying just over the weekend after they bought First Republic that, okay, we're done. And that was the worst one and things should be good from here. And then now we have this, sell off again.
Yeah, he would love to restore confidence, but I thought I would have said that was wrong on Monday morning. That's what I told my people. I said, is this the final cleansing clearing event? And I said, maybe, but when you look at how the shorts just kept pressing FRC, First Republic Bank, even after that $30 billion backstop in March, it makes you wonder how many more banks they can do this to, because, so last week, let's just catch people up here. So last week, First Republic reports earnings, and they revealed they lost, maybe $100 billion in deposits. It seemed like that was a surprise to some people because then, they cut the stock in half and by another 80% in a matter of days, from like Wednesday to Friday. Right. We didn't hear Jamie Dimon come out and say, yeah, this is probably going to keep happening, because he doesn't want to make it worse. He doesn't want to yell fire in a crowded theater like Bill Ackman. And then over the weekend, he becomes the best bidder for the assets, the existing deposits and loans. and gets a great deal. He obviously could step up, but so now he's willing to say, oh, it's, this is the end. But man, like that's the point I've been trying to make. You and I talked about this back in March when I bought the regional bank ETF KRE.
Yeah.
I said, there's nothing to stop the shorts from continuing to do this to a bank. And if they can keep doing it and scare people and then the depositors leave, it's just going to keep happening. And we're seeing it today. I didn't even know that, you told me, because you're looking at this, PAC West was down 30%, PACW. Yeah. And I just look at it now, they're still down like 24% today. So the short bear attacks are still going on here.
Yeah, on a few of these names. And then all of the regional banks are just being sold off in general. That's just regular investors, I feel, getting out of the space again, if they were still in it, kind of like my value investor, although we are still holding on to ours for right now. But you do see in the charts, you had, like with PAC West, you had the initial plunge on the Silicon Valley Bank news, and then it was pretty stable for, over a month and a half. And now it's taken the next leg down, new 52-week lows. So I don't know, like these are the questions for investors out there. I think you've been saying some interesting stuff about, who is in these stocks? Who was in First Republic last week? Like, other than the traders, like would normal investors? I'm sure some normal investors still got caught on Monday after the buyout.
For sure, because you sometimes heard about the mutual fund or hedge fund manager or asset manager who sold their shares. They were down 50%, 75%, and they just decided to sell the rest in Q1. But if you looked at Twitter or stock twits, where you have a lot of active traders and retail investors, there were many who thought that, oh boy, this thing's a steal at $12-13. This is FRC, because the analysts think the balance sheet is fine and they still have $40 price targets, even though it just fell from 120. Right. And I think people fooled themselves about, what is, like what's their evidence that it has to go back up when really markets are full of black swans. We think of black swans tending to be an event, a macro systemic event that affects the whole market. But even within individual stocks, there can be big surprises, right? A CEO gets caught up in fraud or something, or the books are cooked. That for an investor, that's a black swan in an individual stock. Why did people think that the upside was greater than the downside in something like a regional bank that was clearly under siege? And you just had this big test. The big banks do a $30 billion backstop for FRC in March, and the stock still went lower. I mean, that was kind of like the warning flag of there were worse things to come.
Right. I've been following some of what the insiders are doing on these regional banks because I run the Insider Trader here at Zacks. And so it is an interesting take on who at some of these banks think that their stock is a bargain, that they're not having the problems that some of these other banks are having, and that, the baby's being thrown out with the bathwater type of scenario. I was curious to see how many, if any, would be buying from some of these banks. And there have been some. Now, we can only buy, and my screens only show the better Zacks rank stocks. So if some banks, are seeing their earnings estimates being slashed and things, then I'm not going to see a lot of those trades. But some of the ones where the banks are out of favor, some insiders have been buying, like Huntington Bank shares. That's appears on a lot of lists that are on like StockTwits and Twitter, and it's down pretty sharply again now that the sell-off has resumed. But a director bought in there just last week, 20,000 shares. Texas Capital Bank shares is another one where the 2 directors bought in there last week. That's TCBI is the ticker there. That's been real weak. And then a bank I haven't heard of, but it's called People's Bancorp out of Ohio. It's a small cap regional. 3 different directors have been buying in there even this week, but that just hit new lows and its dividend yield is now 6%. So I have been looking around to see where some insiders are actually buying, because that's sending like a stronger signal. At least someone on the inside believes that they're not having these issues, right? Or even if the bank themselves are doing a share buyback, like Bank OZK has a share buyback, and they have been buying while the shares have been, crushed down quite a bit. So
I'm glad you brought that up, because the insiders is a piece of evidence that you could hang your hat on, right? It's not everything, but it's right. but at least it's a piece of evidence that people who know the books better than anyone are saying, right, hey, I think we're a buy here. Whereas, when I think about the people trying to buy First Republic at $13, $14 in the past month, they deceived themselves, because, as I said on Monday morning, where was the evidence to hold any beliefs that it would go back up? And it makes me think of the AMC crowd, the people betting on the MOAS, the mother of all short squeezes, in AMC. And, I kept telling people, like, this is a movie theater. There's no reason it should have this valuation. And if your evidence is there's some conspiracy with Citadel and all this, like, if that's your evidence for placing the trade, you're taking a lot of risks. So you have to really understand what you're betting on, and have, because we could all tell ourselves stories. And this is the nature of behavioral finance. We can construct a narrative and collect evidence, confirms our biases, and we can put together a great story about why to buy a stock. We see it happen all the time. We're all actually susceptible to it, right? We ignore the bad news and say, yeah, but there's A, B, C, and D that make this stock a buy. And so we all sort of have to get used to being taking the counter of that. Like, well, what if, what am I not looking at? And what if those 4 catalysts aren't as strong as I think they are? And, we just have to be honest with ourselves so we don't throw our own money away.
And I think we see that a lot of times with companies that have been struggling for a while, that might be possibly heading towards bankruptcy. And I'm thinking about like Bed Bath & Beyond, which finally did file for bankruptcy recently. But that was a long road to the bankruptcy. And we had some memesters and some Reddit people in that stock too. And it did get a little bit of boost during the pandemic, like a lot of the retail did, as we all rushed out to buy bread makers and coffee machines. We did go to Bed Bath & Beyond to get some of that. But once things normalized, then their business went back to being the struggle, and they couldn't keep it together. But that was a case where they were warning investors for, I want to say, a couple of months even, that bankruptcy was possible. And yet there were still quite a few people in it, including like a friend of mine, the father of one of my friends. And he had been a long-term shareholder, like way back in the day, like 10 years ago, when it was paying a nice dividend, and we all did shop there. So it made a sense as an investment. And it was just a small little part of his overall portfolio. And he said he didn't pay that much attention to it. And so I kept telling her, like, hey, does he still own that? If he is, he needs to sell it, even though he would have like a big loss in it. And so she did tell him, like, hey, Tracey says that they're warning about bankruptcy. Are you still in this? because he wasn't really paying attention to it because it was just kind of a small portion of his portfolio. And I do think it's hard for some of us to believe that a company like Bed Bath & Beyond that we've been going to for like 30 years or something, that it could just go away, that it could just go under, because they've had all like 4 or 5 different strategies to turn it around. They've had like that many CEOs in the last couple of years. They got new board members. They were doing all this stuff that seemed like they could save it, but then in the end, they could not. But I do think it's hard for investors on companies like that to know when to get out. And it, goes back to like, when do you sell? Because it's terrible to sell something that you have a big loss in. And, that's human nature. We want it to come back at least a little bit more than what it was.
All of these are good case studies too for investors. It's like, we could almost write a book on, stocks that went away, companies that went away when you never thought they could. And I always think about, you talked about insiders as evidence of, a piece of evidence that there could be some value here because you have real people who know putting money on the line.
Right.
The other thing I look at is outsiders, which is what I would call M&A, right? So when there's M&A, when an acquirer sees value and they step in, so you have to ask yourself, why didn't an acquirer come in sooner for Bed Bath & Beyond? And I think it's because anybody went from huge Walmart to another small competitor. I'm not sure what the small competitors for Bed Bath & Beyond are. You know better than I do, but even a Target, they look at it like, why would I shell out a few billion when I can just wait for that thing to keep collapsing? It eliminates competition. Maybe I'll pick up their inventory and maybe I'll pick up their big boxes, right? It's like, who's already going to move into all the big boxes that or mall outlets that Bed Bath & Beyond owned,
Right.
So and this is what I told people during the AMC frenzy, when they were still saying, oh God, I own it from 40 and I'm still buying it at 20 and I'll buy it at 10 and now it's 5. I said, listen, the reason that AMC is overvalued is because you guys keep doing this and you believe in this short squeeze and taking down Citadel. But let's look at some evidence. The evidence at the time was that Jeff Bezos from Amazon went out and bought MGM for about $5.5 billion. Now, he obviously saw that MGM had some assets that he could use for, Amazon Prime and whatever, right? Like the whole giant movie catalog and branding and whatever. Yeah. But he only paid $5.5 billion. Meanwhile, traders were thinking, AMC is worth, who cares if it's worth $30 billion? It's going higher. Like, just look at reality.
Right. Yeah. I feel like a lot of things are, changing here in our kind of market conditions that we now have. And what kind of advice do you have for a lot of the people who bought, some of the more speculative plays, not necessarily the memesters, those ones, because those were definitely front and center, like AMC out there. But the ones who bought, the tech company that doesn't make any money, but everybody was buying them in 2020, 2021, it went IPO then or whatever. I have a friend whose personal trainer was buying a lot of these kinds of stocks. And so I started following one of the ones that my friend told me he was buying. And it's called Vinco Ventures. And it's ticker BBIG. I'm almost reluctant to put that ticker out there right now because it's only trading at 16 cents now. But its 52-week range is 15 cents. And then it was at $2.34 at some point in the last year. So this is one of those ones now that's gone under the dollar where, the traders and my friend's personal trainer thinks like, oh, all it has to do is go up to 30 cents and I double my money, right? So I'm going in and out of this. But meanwhile,
sounds like a
they've been
crypto.
at this, right. It's been at this lower level for a while. So they've got the NASDAQ delisting warnings. They're trying, they have a new CEO and CFO I discovered when I went in to go look at it for this podcast, because I've never really looked at it. I've only just followed it on StockTwits just to kind of see what it was doing. I didn't even know what they did. I just knew it was one of these more speculative, techie type of companies. And it turns out they convert content to digital and social platforms. But they did just announce in April that they're acquiring the National Enquirer and the Examiner and Globe, those newspapers that were always at the front of the checkout stands. And they intend to leverage it. Like Enquirer has a big library of like celebrity content and things. They're going to try to leverage it into something. But meanwhile, they're trying to do a reverse stock split so that they don't get delisted. And all of this is going on. So what kind of advice do you have for someone who finds themselves like stuck in a stock like this? This is like a classic of the behavioral finance. It's gone down to 16 cents. As of today, May 2nd. But they are doing some stuff, but, they may or may not be delisted. They're going to do the reverse split. Like, do I just get out at this point? Like, who is in this? I don't know.
Yeah, I don't have a lot of advice on penny stocks because, if you're already down, 99% and it's trading less than 50 cents, you have no money in it. So you might as well hold it. But I do think we have a great case study with what happened in software during the pandemic. We just when we went work from home, the stock market collapsed. We have this mini flash recession, I called it, and then the stock market's roaring back. And then later 2020 and 2021, you just saw this roar in software and fintech.
Yeah.
And Zoom was going through the roof, and all these different companies because it was remote work, and you didn't just need Zoom, you needed like the infrastructure, the bandwidth to support people having high-speed connections at home, and et cetera, et cetera. And then fintech. So I did a lot of content on that stuff and made some money on some stuff, but then also got caught myself on buying things too high because the rising tide of software and fintech did lift all boats. What ended up happening was, you get caught in the idea that the momentum is going to continue forever, and you buy things at too high of a valuation, which the quantitative bears, and I'm talking about like Wall Street professional sharks who run the numbers both fundamentally and technically, they're waiting to short this stuff. So, you were encouraged when remember buy now, pay later. So Square goes out and pays $29 billion for a company called, I think it was Afterpay or something. And it's like, and so that's lifting all boats. But then when these things start to go down, you have to apply risk management. And if you got caught up in the euphoria, it's okay. Now you can't get caught up in the fear of regret. There's all kinds of behavioral biases, and people don't want to sell something and then regret it later. But this is where you have to have some rules. We all know the rule of 72 for calculating your return, and your compound return on things.
Yeah.
I made up a rule for trading called the rule of 14.
Okay.
And the rule of 14 can protect you from losing more than 2% of your account. So the rule of 14 is you can go up to a 14% position in any one stock. Now I bet that you, Tracey, as a seasoned investor, probably don't have 14% of your portfolio in a single stock, but it sometimes happens to people.
Yeah, yeah.
But here's the risk management rule. Go ahead. If you want to bet the farm, like I have done sometimes on NVIDIA, go ahead and make it, over a 10% position in your portfolio. But if you do, you have to use a 14% stop loss to make sure you don't lose 2% of your account equity. So that's the rule of 14. You can go up to a 14% position, and have a 14% stop loss and still lose less than 2% of your account equity. Now that's a pretty, safe rule. And since we don't recommend that people, have positions that are 10 to 15% of your portfolio, it kind of sort of tells you, so if I have an 8 to 10% allocation in a single stock, then maybe I can have a 20% or a 25% stop loss. So that's the way you want. That's the thought experiment. What it reinforces is that you still have to have a stop loss. Don't let things go to a 50% loser, where you're going to be in that emotional regret state. Like, oh my gosh, what if I sell it and it goes back up? All the best investors have some risk management rules. You alerted me recently that Warren Buffett sold all of his Taiwan Semiconductor, and it was a genius move to buy it in the past few years. I mean, their revenues have more than doubled since 2019, because they are the foundry to make the chips for NVIDIA, Apple, Qualcomm, AMD. They're like the architects of AI and mobile and autonomous everything. They make the designs, but then they send it to Taiwan to actually fabricate the chips. So Taiwan is a cash cow. Taiwan Semi, TSM. But, and I just did a Bear of the Day article about it to highlight their headwinds. So tell me what you saw that Warren Buffett saw that made him sell.
Well, we don't know exactly what he saw, but Becky Quick did ask him about it when she just had him on, Squawk on the Street or whatever, Squawk Box, for a couple of hours when he was in Japan. And of course, they had to ask him about it because this was the first interview he's given and the first opportunity to ask him about that sale, because that's very unusual for Berkshire, because as we all know, Buffett has always said the time to sell is never, basically. And why would you buy a $4 billion position, and especially in a semi that he's never been in the semis that I know of, and then sell it the next quarter when there was no other news or anything in there? That didn't seem to make any sense. But he did tell Becky it was because of like the geopolitical issues in Taiwan with China there. And he just saw that it was too risky and wasn't willing to be in something that was that risky, even though you would think, well, didn't you know that when you bought it in the third quarter of 2022? That there was risk there too, but it could be that, some of that has changed. And then he just did deem that would be too risky and decided to get out. And there are geopolitical issues with a lot of companies. I mean, things did cross my mind about, say, Starbucks. Its second largest market is China. What happens there if something were to happen between China and Taiwan? What happens to Starbucks business in China? Like, that might not be too great,
And his initial ideas when he bought it, he may have known about the China risk, but then things did sort of heat up in Q1, where China's doing new military exercises around Taiwan, and so this is an example of, Warren Buffett's not perfect, and he'll be the first person to tell you that, but it's an example of, you are allowed to reevaluate your original thesis. And in fact, you should reevaluate it and say, what? Maybe I was wrong about the upside, or maybe I was wrong about the risk, and I'm going to make a new decision now about the risk reward and say that, because geopolitical risk is, it's one of those outliers. It's almost like government risk, right? Like you can have a great thesis about a company, but all of a sudden the government or legislation comes in and completely changes your industry or business model. You can't fight that. So if you can anticipate that risk, then you can reevaluate and make a new decision.
Right. So on that note, just recently, the government of Chile announced that they were going to nationalize the lithium in the country. They are the largest lithium producer, which is used in electric vehicle batteries, among other things like smartphones. But that was huge because there are companies, Chilean companies, SQM, that is the big manufacturer there. And so when your government just comes out and says, hey, we're going to nationalize you, we'll give you a couple years, we'll give you till 2030, but we still may want, to come into the agreement earlier, blah, blah, blah. Like, that's not good. I owned SQM in the value investor and in my own personal portfolio, but we did sell it because these are like headlines that you can't overcome as an investor. If they're going to nationalize it, they're going to nationalize it. There's nothing you can do. But it did come quite out of the blue. I mean, it was always a risk, I suppose. It is with any kind of commodity that it could be nationalized in that way. But it still was a bit shocking for those companies and the industry in general.
I mean, I always talk to my people in my services, like Taser and Healthcare Innovators, about you got to check your biases. Like, we all have biases. We all fall for a narrative, and then we want to reinforce it, and we want to have conviction, and we want to have confidence, and we don't want to admit we're wrong. So
right.
I have to do that with the CRISPR stocks, which I'm back in the CRISPR stocks in Healthcare Innovators. And so far it's working just because, I bought at good levels and I see there is just generational upside in these things, but, I could be wrong. So, but I want to talk about another sort of behavioral fallacy or bias or trap that people fall for that is not stock specific. It's the doom and gloom. And I wrote a Twitter thread last week about what I call dollar destruction hysteria. And I made up an acronym for it, DDH, dollar destruction hysteria, where all of a sudden everybody, all the so-called experts on YouTube and in other newsletters, thankfully not us, are selling the doom and gloom that the dollar is going to heck in a handbasket. And listen, I was a currency trader at the institutional level for 10 years. And I remember and this is at the launch of the euro in 1999. So I got to see two things going on. We've got the launch of the euro, and then we had China at the time saying, or there were ideas that China was going to sell all its U.S. treasuries and do all their business in the euro. Well, obviously that didn't happen. And then when you look at what the dollar has actually done, like in the past decade since the financial crisis, it was up 50%.
Yeah.
And then remember the middle or the late 2010s when we were sort of in a halfway recession in 2015, energy companies were doing bad. The Fed was keeping interest rates low because they couldn't get any inflation or growth or employment. That whole time for 6 years, from 2015 to 2021, the US dollar stayed in a range of 90 to 100. And that's the US dollar index, of which it's weighted 58% against the euro. So it was like, even during all that worry, the dollar is pretty strong. And then in the past 18 months, the index spikes up to 110 because we're raising interest rates. And that's a clue for everybody that interest rate differentials tend to be the constant current of driving FX flows. So now the dollar has, it's rallied fantastically, and now it's back to 100 on the index. And you've got everybody saying, "Oh, it's going to collapse." We printed too much money. But what people forget is that it's all relative in FX. The dollar is always going to be valued against the euro, and the Chinese are going to go deal oil. With Russia, they're going to start using the yuan or whatever. Like, that's a small part of the dollar's value. The dollar's value is in, like, what people don't consider. It's in our financial markets, the breadth and depth and stability that any company can do business with us, whether it's in our financial markets or stock market or trade, and they can trust the rule of law. The markets are deep and liquid. The rule of law prevails. It may not be perfect, but and our government certainly isn't perfect, but our model of a constitutional republic functions relatively better than a lot of other countries. So that's another, relative value of why you own dollars, because you want to do business here. You want to buy assets here or do trade. And so the idea that the dollar is going to collapse because we printed too much debt, it hasn't borne out. It just hasn't borne out because, and that's a whole nother debate. I mean, the debt is not, politics aside, it's just a trend. But so even though the debt is greater than GDP, annual GDP, what it's still dwarfed by is the wealth base of the nation, and that's assets and real estate, real property. So there's so many. If people want to read the Twitter thread I did, just go follow me on Twitter at Kevin B. Cook, and you can DM me or whatever, and I'll send you to the Twitter thread and some supporting videos and podcasts and sort of that sort of thing that takes you through all the points you need to consider to accurately assess, whether the dollar is actually collapsing and your money's going to evaporate. Listen, the best trade of all for the past 20 years is just to be an investor either in stocks or real estate, and you clobber inflation.
Yeah, good point. All right, I like that. DDH, dollar destruction hysteria. I like that. I'm gonna watch out for that to see if that starts.
It's like somebody goes on YouTube and makes a video like about this, this doom and gloom, and then people want to believe it. So we get caught up in it. It's like, we like the doom and gloom sometimes. Yeah,
for sure. Okay, so let's hope there's some people out there who maybe, got a little bit of help from this podcast on what they should do if they own some of these stocks, like to be aware of their own behavior and their biases. And also, keep an eye on what's going on with these banks. But as always, it's always a good podcast when we have you on, Kevin, because it's got to be something to do with, behavior and psychology out there. Okay, so I'm going to recap a lot of the stocks we did talk about on this show, and it is pretty wide ranging. But starting with some of the banks, we talked about PacWest, its ticker PACW. I mentioned Bank OZK. I own it in my own personal portfolio, and it's in the value investor. OZK is the ticker there. Huntington Bank Shares is one of the ones where an insider has been buying recently after their earnings. HBAN is the ticker. Texas Capital Bank Shares, another one with insider buying. TCBI is the ticker. People's Bank Corp, another one where some insiders, 3 directors have been buying. Its ticker P as in Paul, E as in Edward, B as in boy, O. PEBO. And then we talked about, of course, AMC. That's still AMC. Taiwan Semiconductors, TSM. I mentioned SQM. That is the lithium producer in Chile. And then I also mentioned Vinco Ventures. That's the stock that's trading at just 16 cents now. That's buying the National Enquirer. Ticker B as in boy, B as in boy, IG. BBIG. And as always, you want to be sure to subscribe so you're getting all of our podcasts, and you can get them on Apple Podcasts, and we're on Spotify and Amazon Music and just about anywhere you can get podcasts. But be sure to get us somewhere, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.